And 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. And welcome to my podcast. So the war goes on, the confusion continues, and it's affecting the rally. But what has happened in the last 10 days? Well, in the last 10 days, we've had this relief rally. From March, actually you go back to March 30th, that's when it started, to April 23. But it was a short covering relief rally, which those rallies are fake. They're weak. And like this particular one is driven by just 3 stocks: Amazon, Nvidia, Google. Now, the interesting thing is this, that we've reached a point where all the shorts have finished covering. They bought their stocks back. It's done. Now, if the institutions don't start buying, what happens? Well, what happens is most fake rallies. They correct. So what do we have to start looking for to see if this rally is not going to correct and keep going? Well, we know that the institutions are the most important thing. We got to get their money in here. We got to get their money out of the bond market, especially investment grade bonds. That's where they are. So as long as we got this war going on, or this half-assed war going on, we're going to keep getting, a mixed direction signals, especially now that we have the shorts covering. They're done, they're gone. So what do you watch now? Well, you watch now a couple groups. First of all, you got to watch the consumer discretionary. Why is that? Because the consumer discretionary, or cyclical stocks as we call them, and they love low yields, they're the real backbone to our economy. I mean, they're the backbone to the market. Always has been, always will be. So you got to watch XLY is the symbol for consumer discretionary. And you got to hope the yields go down, because that's what we need. So when you have all the institutions with $18 trillion sitting over here in bonds, and we're waiting to see if they ever come aboard, we just don't short this market. We have to watch it. So that's one thing we watch. So the next 5-6 days, trading days, we'll watch that. We also have to watch very closely is IWM, the small mid-cap stocks. Because while the consumer discretionary is the backbone of our market, KRE, or IWM, the small caps, they're the core of our economy. That's IWM. But you have to have the small banks, the small mid-cap banks, KRE is the ETF, to go up. We need them to go up. And they like high yields. So here's the problem. We need low yields for the consumer discretionary, symbol XLY, to go up. We need IWM, something to push IWM up, the small mid-cap stocks, and that's always the small banks, KRE, but they need high yields. So we got a need for low yields for the consumers to go up. We got a need for high yields for the small banks to go up, to push up IWM. So what's going to happen? That's going to make the market choppy. Now, if anyone tells you that this rally has not stopped the short covering rally, they're dopes. It has. Because remember, we saw 10 straight days at the end of the night, trading day, we'd be negative. Next morning, we'd be positive. Had nothing to do with the plunger team. That is the typical panel of a short covering market. A relief rally market. That's what you see. So now, what's going to happen is this. When we're watching, and this is very important to watch these two, because they're going to tell you what's going on, because we are not going to get institutional money back here. And at any time, this market can crater or correct or crash. So we're going to expect real chop. Now, we got a heavy, heavy week of tech stocks. Here, let's take a look, reporting. In tech stocks, you know what happens. They always beat their own estimates, right? We know that. It's a game. They always beat their own estimates on earnings. It's a joke. So I got a little list here for you. I think I did. I'll put it together here. Let's see what we had. I think we have Wednesday is when we get Microsoft, Amazon, Meta, Google, Apple's on Thursday. That is going to tell us a lot. Because if we can keep the three stocks going up, and we can get the same old, oh, they beat the street by a penny, then we could get this rally. But it'll only be a pop, and it'll come back shallow, nothing big, and we're going to continue this choppiness. But during earnings season, we all know the market goes up. Because what makes it go up? They beat estimates. As long as they beat estimates, stock goes up. And the estimates are all fake. Because the CEOs set the estimates themselves. And they lower them. So when the analyst comes out and says, oh my God, we're going to have a 1% increase, they already know it's going to be a 5% increase. So then the day they report, oh my God, this is a 5% increase. Okay. So let's look at something else. So we know this is done. The short covering rally is done. We don't have the institutions. They're still sitting in a safe haven of bonds. And we need the two biggest groups that are so important, okay, to perform. And that's your small, mid-cap stocks and your consumer discretionary. So put your eyes on that next week. We also know we got all the earnings are coming in the tech. We're going to get all these shallow pullbacks. We know that. So you got to stop buying, however, on these dips. If you keep buying, you know where most money is lost in the market? Is buying on dips, buying at 9:30 in the morning, 9:30 to about 9:30, about 9:35, 9:40. That's where all the money, most of the money is lost. Because people jump into the market not knowing what they're doing. I better get in just as the market opens. No. You're better off waiting until you can see if your stock, when it opens, you look at it, the candlestick, and you want to make sure the high, when it opens, you have a high and a low, right? High, low in your candlestick. By 5 after 10, if that high still isn't holding on your candlestick, you're in trouble if it's at the low. By 10:35, it's still at the low, it's over for that day. So, again, don't be jumping on stocks. It's not going to be helpful, okay, at 9:30. Make sure you're protecting yourself in any stock you're in, and you decide you're going to add to it. Wait until 5 after 10 to make sure the opening high, it's at the opening high, doing a good job at the opening high. The volume in the last 5 days is excellent, and your pricing trend, your stochastics going up nicely. That's what you need. That's the footprint. That's the footprint, okay, that you're looking for to see where the money's going. Now, what has not changed, what has not changed is still around, is the negative breadth. We still have the same three tech stocks, Amazon, Nvidia, Google, going up. We still have more stocks going down than up. Institutions haven't rotated out of investment grade bonds, so they're not buying the six cyclical groups, okay, which is the backbone of the market. They're not buying the core of the economy, which is IWM, which we need KRE to push IWM up. And the problem for the market is the institutional money won't budge. Now, what institutional money is doing is day trading. They'll trade a spread of 1/10, 2/10, 3/10. They make a ton of money day trading those because they'll trade millions and millions of shares and turn them, bam, bam, bam. Their computers are set up. They can trade these so fast. Where you and I got to have a 2 and a 3% spread, they need 1/10, 2/10. So we do have institutional money helping us with day trading, but that doesn't work. Not for a long time. You need them to rotate. So therefore, okay, without this short covering, the only thing that can move this market is higher earnings. We just talked about that. And the higher earnings, okay, they'll always beat earnings. We know that. Earnings will always be beat. They always do. But that's not enough. That's not enough. For the rally to continue, we need yields to head towards 3.9%. That's the problem. Yields aren't heading towards 3.9%. So they always start heading back towards the danger zone, which is around that 4.5, 0.47. Keep your eye on that. If you start seeing the yield, the 10-year Treasury, always pushing towards 4.5 instead of, so let's say, so today, just take a look. Today we're at 4.3. So just know when you're trading 4.3, if that yield keeps heading towards 4.5, especially if it gets higher than that, this market's going to crater. You want it to going down to 3.9 or lower. And for that to happen, what do you need? Well, we need cooling inflation, but we don't have cooling inflation. We need weak economic data. On the surface, we don't have weak economic data because they fudge the numbers. They lie. Because the politicians, Congress control it. So they're always going to lie. So always understand this. We need, okay, to get down to that 3.9 or 4%, we need, okay, cooling inflation, weak economic data, big job misses, like, oh my God, 100,000 jobs less than we expected. We need manufacturing to contract. We need, okay, there's a lot of stuff we need. This is we need bucket list. We need manufacturing to contract, to slow. What are you, nuts? This is crazy. Until we do, institutions will stay in bonds. And that's why when you look at the Buffett warning, as they call it, or Buffett warning, what's it called? The Buffett indicator, remember, this thing is spot on. It told us exactly when the dot-com crash was going to start. We were around, I think, 145. He nailed it. It told us exactly when we were going to have the housing financial crash. I think it was around 150, I think. 115, thank you, 115. Right on, and we crashed. We're at 229, I think, or 227. Imagine that, 227. But that is associated with these three stupid stocks: NVIDIA, Google, and Amazon. Now, if you're in these stocks, don't fall asleep. We're in these stocks and we're making money. But every time that you get a rally like an Amazon, like look at today, we had a nice breakout rally. It started to consolidate, started to consolidate really on April 14th. We got a nice breakout today. You should sell into the breakout and take profits. Put it in your pocket. Also, okay, Meta, same thing. Trade these. Put stops in. Take profits. So there's a lot we're missing in this market, isn't it? But we can make money either way because we know how to short too. So those are just some of the things you got to think about. See you on the charts.